This is Justin Pulitzer. This is my weekend review video for Sunday, April 10th, 2016. Good amount to cover. I'm going to dive right in. I'm also going to try and make this video a little bit shorter since I got a little bit of a late start getting it up. If you happen to be catching this and the resolution is low, just realize it's being shot in a very high recording value over 4K. If you are seeing this and you're having trouble with the resolution, just pause it or reload the page after a little while and it should be a little bit crisper. Anyway, let's jump in. We're going to start out with the 6 market keys, flow into the 7 Fed keys, and then hit up the indices and some stocks. As usual, I like to kick it off with the VIX to see where we are within range. I created a key I'm sure most of you are familiar with by now. I may make some tweaks and adjustments along the line with this as so needed, but as of now, this is how I see it. Let's do a little bit of a look in the VIX. See, we had this period of time where we were fairly benign with some relatively small spikes, but we're starting to get a little bit more bounce for your ounce, so to speak here. This was the flash crash. Since then, we've been making lower highs. Here, it looked like we were sort of trying to transition into a new era of volatility, but those hopes were a little bit assuaged with a break below that line, although, however, we are holding the lower end of the VIX range. So I will say this, we are oversold here short term on the VIX. You can see it's starting to bend back up. We could be in for a period of some increased volatility. I will show you this. I'm going to zoom in a little bit. You can see here the 20-day moving average was some resistance. Now, the last couple days, it's been acting as support. So I would be a little cautious here with regard to selling premium or with longs until you kind of see this settle back in. I'll give the example here. I wouldn't be chasing longs until I kind of see the VIX chill out a bit. I guess beer before liquor, never felt sicker. Liquor before beer, you're in the clear. So in this case, the VIX, let's see the VIX have a little bit of trouble with the 20-day moving average, or at least have some type of a spike and not really start ripping. You can see it's failed now 3 times on the backside of the old trend line. These levels are key. They play off, but I think there could be a little bit of more risk up to the 17s and maybe even into the 20s. This area obviously is a big confluence of levels, the 200-day moving average, the 50 and the 100. So I think up in this region should probably see some maybe sellers of premium. So there could be a little bit more of a move. So we'll see. 20 MA there is the key. The dollar is starting to come apart at the seams a little bit here. You can see I drew in, we had this big rally, sideways consolidation, and I drew in a range. The moves on the other side, the wrong side of the range, have not been sustainable for very long. You can see we're sitting below there currently. Moves on the upper side haven't been sustainable either, but they have been shown a little bit more resiliency as opposed to here. You can see we spent a lot of time up there. Let me zoom in a little bit more. You can see here they tried to have some bottoming tail action, and then this Friday made a new low for the range. So you can see the high here of this day was 24.48, so it was 1 penny above the range. I would say if you're aggressive and you get some type of a gap up or a move over this high, you can play row long with a stop versus that low. I think that would make a little bit of sense considering how far we've moved down. I will say this, though. We are starting to show some relative weakness. I think a lot of this is a result of the Fed and the talk out of the Fed. Also, some of the yen strength. I don't really want to get into that too much. I will if it persists this week. I'll start in on that on Periscope and get into it more into the weekend review video. But just know that there's a carry trade out there, meaning people short the yen in Japan and then use that proceeds to buy stocks in other markets, and there's a bit of a blowing up of the carry trade. So what they have to do is sell the stocks in the other markets like Europe and the US and buy up the yen, and that's put a lot of upward pressure on their yen. It's sort of the funding mechanism is having some issues. So we'll get into that if that continues this coming week. Anyway, what you really need to focus on now is this level here. If we can sustain below the 24.47, and if so, can we really start getting some range extension now back to the lower side of the rotation below the range? So the bonds, the TLT, this has been a cause of great angst for people. Why? Because we have been in a historically long period of bullishness for the bond. Look at this. This was the 2009 crash peak. The end of the world was happening here. Lehman Brothers, Bear Stearns, all that stuff. Moves up here have not been always so sustainable, but we are above there now for a stubbornly long period of time. So I'll say this. We have relative strength here along the 50-day moving average. That has been, I guess, I wouldn't say rock solid support, but moves below it have not been so sustainable. We're starting to make higher highs and higher lows in an upward trend. I don't necessarily know that you need the bonds to really completely blow off here to remain bullish in the equity markets, but it's evident that the bonds are telling us that the Fed isn't in any hike mood anytime soon. You have a trend line coming up, so there could be some more pressure to the upside. I do think that there'll probably be a little bit of responsive selling there, but this is sort of starting to form a bit of a cup and handle pattern. So what does that mean for stocks? A lot of people, the media, a lot of less experienced traders or people who, I guess, don't really understand the relationship between interest rates and stock prices, seem to think that the bond rally is spelling doom for the stock market. Au contraire, mon frère. It is exactly the opposite. The risk-free rate, which is treasury yields, are used in what's known as a discounted cash flow model. I've discussed this in past videos. I don't want to get into too much detail. At some point, I will do a dedicated video on this. I just need some time. All you need to know is think about it as a division problem. If the lower number, the denominator, is higher, you have a lower end product, which is in this case your stock price. And if you have a higher number, you get a lower stock price in the end. So higher stock price with a lower denominator, lower stock price with a higher denominator. Think of the risk-free rate as a component there. This has caused a tremendous chase into other stocks. I wasn't planning on talking about Coke, but I will. You can see Coca-Cola is basically making all-time highs. We are getting close to some resistance, although I do think that this could see the 1.618 fib extension up in the 50s. So Coke seems like it's got a rendezvous, it's got a date with destiny up there. People are paying like 23 times earnings for Coke. Coke isn't really growing all that much. They're doing that to chase a 3% dividend. It just kind of is how it is. So as long as bonds stay strong, they don't need to really rally. They just can't crash, when you can't see this kind of action. Then stocks deserve to trade at a premium PE multiple. This is driving the bears and fundamental traders crazy because you have very weak economic numbers. The Atlanta Fed, I guess I'm going to segue and jump into the 7 Fed keys for a little bit here. We know the Atlanta Fed has a 0.4% GDP estimate for the first quarter. We've had a few years, this is now 3 years, maybe more in a row, where we've had very weak first quarter GDP. It seems to be a new norm. However, it's confounding people. Why is the stock market staying so strong? If growth and earnings are contracting, it's because those earnings are getting a premium multiple because bonds are so low. People always forget about that side of the equation. When markets peak, they tend to be when interest rates are 5 or 6%, not when they're 1 and 2%. It's just sort of not the natural order of the world. So that's the deal with the bonds. Anyway, let's jump into some of the other stuff. I'm going to try and come back to the Fed keys. I am definitely coming back to the Fed keys. I just want to get through the market keys, but that's really what you need to know about TLT. The lower for longer, the better for stocks. That's just how it is. The oil. I had mentioned this, that I thought we were through the worst of it last week. It turned out to be prescient. We got a pretty sharp rally up. This, I think, buried a lot of shorts. We haven't cleared the last high or the 200-day moving average. The 200 is really key. You can see it was a bit of resistance here. Here we didn't even get to it. It was showing a lot of relative weakness. It's good, though, that the 50-day has held, and we seem to be in a bit of an upward move.
I think as long as we remain above the 37s area, see we had a bit of a look below here, spent a couple days down there, but it failed and rejected to the upper area. I think that as long as that we're above these 50-day moving average, 100-day moving average, and the 37s, the path of least resistance could be higher, maybe close to $50 in oil. That's kind of what I'm looking for. We need a little bit more confirmation. The XLE, which is the energy ETF, is up against a little bit of trend resistance. Let's do a 3-year daily. That shows it. You can see. I may have gone a little too far with that, but all right, you can see we're in a downward trend here. And here the frequency of the touches are starting to compress. That's good. We're making higher lows, compressing above some key moving averages. Let me get back into real time here. We have an upward facing 50-day moving average, 100-day moving average, and we're above the 20. It's sort of building pressure. We're above this last swing high. It feels to me like it wants to kind of probably move up and out and get into this range. But let's not anticipate. We could easily see a move back down to trend and then go. But we can see the triangle is sort of narrowing. It's not helping that we're kind of rolling over a little bit stochastically. But I do like that we kind of had a bit of a mild back off. You had these double bottoms here. You had a violation here of it, but we rejected back up quickly. It's good. I would say if you lose these lows, the 60-46s-ish area, that to me would be a short. It means we shouldn't really be back down here. There really shouldn't be this soon anyway, and it would start be getting a little bit iffy to me. The 58 area is key. I was kind of thinking maybe we would see that here, but we did come back up. So I am looking for that trend break, maybe a 200 moving day test, and then maybe eventually moving up into this higher distribution once you kind of clear this area. You can see there's a lot of volume here, a lot of dead bodies of people who bought the dip here. They're being made whole, and it's just, taking a little time. The curious case of Exxonmobil. This is my bellwether for all oil stocks. You can see I discussed in great detail last week the power of 83. You can see it was a lot of resistance here. You did have a push up here, but ultimately not sustainable. A lot of resistance you can see trading on either side of it. We were starting to look like we were breaking down here. Didn't quite get a 50-day test, which is good. I would say 50-day here was a lot of resistance. It started to become support again here. So I would say you can be long and strong Exxon as long as you hold 83 and at the very least the 50-day moving average. You can see it's kind of the tail end of the fat part of the distribution here. And it's in 81s, 82s. That's a very key area. We are struggling with the 20-day moving average, and we are just basically holding the 83. So I would be looking to be long if we can clear the 83s, which is basically 84 and up, or looking for a quick right or right out test or short if we lose the range here. But I will say by the time we get there, the 50-day is the kind of the litmus test. So if we're above the 50, I like it long. If we're below it, I'm a little either flat or testing the row short, meaning right or right out short thesis. FXI, not that much to see here. Starting to make higher lows and higher lows, right, and higher highs. Struggling a bit with the 100-day moving average. Anything above there has been a little bit unsustainable. We're trying to hold the 20. We're now on the backside, riding the backside of the 20. Just to me looks like consolidation. If we start losing these lows here, you can see the 32s. I think you could come down to the 50 MA, maybe get a test of the lower end of the distribution. If that fails, it's going to be Katie bar the doors. I think we're going to come back down to 30. But I'm kind of watching this to see if we can get a backside of the old uptrend test and a 200-day moving average test up around 36. It sort of feels like that's going to happen considering we broke this downtrend and we've just been building out sideways more by time than by price. I'm a little concerned that the stochastics are rolling over a bit, but some consolidation here is okay. We basically held where we needed to hold, and the fact that it's just kind of hovering around here and kind of playing a little catch-up to me is all right. So that's really what I'm watching with FXI. The IBB. So I mentioned in last week's video that for the first time in a long time, we had broke down here. Once we lost the 50, that's sort of when the ish hit the, the fan. Did some consolidating here, started to make some higher lows, some higher highs, and for the first time closed above the 50 very bullishly. Couple of days of consolidation below this range, and then we pressed up pretty hard. However, we are kind of backing off a little bit more than I'd have liked, although we are above these hammers. I'll say this, if you can hold the 75.40 to the 71.77, the worst of it is probably over. Look at this kind of rounded bottom it's trying to form. This was the breakout. This was an old breakout from way back in the day. I don't really want to pull it up, but you can see there was a lot of points of contention here. If this can hold, I would say we're probably going to extend and up into this region, potentially. The 306s to, let's see, what's the low here? 306s to 314-ish area. If this fails, I would be careful and looking for a retest of the 50-day because that was the key, part of the thesis, the breakout. Believe it or not, would not surprise me to see that happen. This has been a very, very iffy and choppy market, but you can't assume that. I think at this point, since we moved up and out, you kind of have to assume that this is a row long. If you lose this candle low and this range low, though, like I said, it's going to be a right or right out short. I would like for put ratios, long one of these, and then short 2 times out of the money here. That to me would work out quite well, or just do a straight 1-to-1 ratio for a put spread. Some of the ways to play this, I've been liking the alchemies. You have basically a hold, a look below and fail, a breakout of trend coming up here. What I think is going to happen is that you're going to get up to the 40-ish level. You might poke into the range. You can see there's a big price void here. So I'm thinking that we're going to see the gap fill at some point, at least to the 50% fib-ish area. Maybe to the 61.8, which is exactly the gap fill. You can see there's a lot of points to go. But what I think is the more likely scenario, since we've run so much, is that we're probably going to look into the gap and then back off a bit and come back in. And then maybe touch trend or maybe retest the 36s area. That's kind of what I think is going to happen here. We got a little bit more up and then come back down, spend some time, and then hopefully go higher. If that was to look up and fail and then really start collapsing, then it's going to be a little iffy. I'll be looking to kind of trim into the gap. The Gilead is one of the better ones. This pattern is starting to improve. You had a gap below. You spent a few days down here and then rejected up. Tried to look below again, failed, and now the pattern seems to have reversed. I think we're going to see the downtrend line and kind of this gap fill up around 101. I just don't know how that's going to work out if we have to come back down again first. You can see the 20-day moving average moves below it have been unsustainable. It's been the channel low. Right here, it's the exact channel low. So I like row long at or slightly below the 20 MA with a tight leash. That to me would be good. I would get a little more iffy here if we start losing the 93s again. Take a look. It was this low. It's sort of also a point of contention where this kind of was breaking out. That to me, that area would be a good area for right or right out. All right, so we covered that. Some important levels to note with regard to the SPY and the ES. Although let's do the Fed stuff for a minute quickly. I'll pull something up. Let me pull up the SPY. But I'll talk Fed for a minute, the Fed keys. So the NFP, the non-farm payroll, the jobs numbers we know have not been good. I know the headlines have been okay. They talk about the 4.9%, and there was a bit of a downtick or whatever, upticks here and there in the weekly claims. But the overall quality of the jobs have been weak. It's been seasonal hires, waiters and waitresses, bartenders, caddies, carnival ride operators, all of those wonderful jobs that when you're when you're a kid and they ask you, what you want to be, in life. Some kids say fireman, cop, astronaut, carnival ride operator. I mean, duh. So the jobs have been weak. I'm not a big fan of what's been going on there. I talked briefly about the Atlanta Fed. The GDP is Last week we heard that the fourth quarter, the revision was instead of 1%, it was 1.4%. Now we're at 4%. Not really good. I think that's going to keep the Fed on hold for quite some time. ISM, there was a little bit of a good uptick in the both the manufacturing and service numbers. After 7 consecutive readings lower, we finally had an uptick. I guess nothing goes straight down. I wouldn't get too excited about it. But what I do think there is good is that it may take recession off the table. I do believe we're really close. It's stall speed, but we're not quite there, and I think that kind of puts that off for a little bit, and would probably put it into a back end of the year type of a situation. I really thought that if we were going to have a recession, it would be early in the year. We'd probably have come in with worse numbers from Q4 and then weak numbers in the first quarter, and we'd have a little bit of an early recession. I don't necessarily know if we do get a recession that we're going to get like the 30 to 60% pullback traditionally in the market. The Fed openly said that market reactions down have been kind of getting less worse because people have been anticipating Fed action, and I absolutely could almost guarantee if you see some weak numbers, they're already hinting. Yellen already was hinting at the ability of the Fed to possibly do QE4. Wow, wouldn't that be something? It just seems like that could be kind of the sword of destiny, that we could be dealing with a QE4 type of a situation. So that's that with regard to the Fed. So PMI, same type of a thing. Durable goods were not so great either. The auto numbers have been coming in a little bit disappointing. We did get a bit of an uptick in some of the reads, but really again here, after 10 straight months of people basically hiding under their beds and stuffing money in their mattresses, they finally came out, I said, and bought some toasters. I don't think we're going to have a toaster-led economy here. I'm a little iffy. Look, the economy's weak. The Fed talks about Europe not doing well. You've got all these problems in these stocks. The Deutsche Banks, look at this. We're kind of retesting the lows. I guess they're trying to do a bit of a double bottom. I think everyone's anticipating it breaking. I'm not anticipating it necessarily breaking. I always like to assume the optimist in me that the reference lows hold. I think you kind of have to until they don't. If this does break, it's going to tell me, listen, they have negative interest rates there. Our banks have been suffering. We all know that the financials here can't get out of their own way. I don't want to go over them for the interest of time, but these guys are even worse. They don't only have zero interest rates, they're dealing with negative interest rates basically over there. So the earnings profile on these banks, that's iffy because of the derivative books. Everyone's worried about what these people are holding. It's also iffy with regard to their earnings prospects, considering they can't really make any money here. Rates are low, so these banks have been suffering. They have terrible PE multiples, single digits. Keep an eye on this. If this low gets taken out this week, I think the market is going to be in for a little bit of a correction, just based on panic over these European banks and who holds what and who owes who and all that, fun stuff. So just keep an eye on the Deutsche Bank. If this stuff can rise, you have Deutsche Bank. It's also Credit Suisse. This is the same horrific-looking charts. These companies are below basically 2000, and I think Credit Suisse is still holding it, but Deutsche Bank is for sure below the 2009 crash low. Not good. This could be some contagion-ary risk. HYG, we also know the Fed watches that. It's been giving us a little bit of a reprieve, just consolidating sideways. Anything sideways to up is good for markets. If this starts really kind of breaking this range, this consolidation range down, you're going to probably get the bees talking again about trouble in the credit market, particularly if it coincides with the Deutsche Bank stuff. Let's go back to SPY. All right, so I don't want to mince words here with regard to SPY. This past week was really, really choppy. I'll tell you, up to about here, I was anticipating. Let's talk about it. I had talked about this number, this 206.76 being a key level. We got up to there, backed off a bit. I had said that it would be okay even if we backed off to the 204s. It worked out that way. We filled the gap. We tested a little bit into the the Fed day range, reversed hard. This is a major bullish day. basically got back up to there and closed above it a little bit strong. The next day, I know a lot of people thought this day was bearish. It really, in my view, I mean, with what happened, obviously in retrospect, it was a little bit more, but in itself, this was really just a consolidation. You had a big up day, worked off a little bit of excess and consolidating. However, this next day, gapping down was rather bearish. You basically kind of took out this low and then just kind of closed weak a little bit below the 204. No, I'm sorry. It held by the skin of its chinny chin chin, 204.19. That's why I think you had this day up here, this back powering move up. But this day really should have never happened. This to me said that something was not hitting right. This day now surprised me. I really thought that if the bears were going to sink in, they had the opportunity to really kind of put the hurt on the bulls. It did not happen. I think you had a lot of people who basically just chased this day and they got out, and then the algos ripped it back up. The one concern I have here is that you've now taken out a lot of the price action of these last 2 days, and you've hit on this 204.12 now once, twice, 3 times, 4 times, 5 days in a row. This is a really key level here. If we lose this early next week, this to me, we could see the 201.90 very quickly, and if that gets lost, we're talking about maybe a retest of the 200 level, maybe even worse. I'm looking at the expected move for next week. It's $3.03. That would take you up to 207.53 or down to 201.47, which is basically where I said we would be, basically down to the 200 area. So 201.47. I would imagine as we come down, IV would pick up and that number would expand out. Could easily see that. It's also possible now that we are in some kind of a range with like this 200 or maybe even 197.86 as being the low end of range. You could see the 50-day is there, and this kind of like 207-ish area is the high of range, so it wouldn't surprise me to see some type of a pullback. I really don't know which one is going to happen. I really thought after this day range we would kind of spend this week consolidating, which we did. I can't say, listen, we're above the 204.19 and above the 20-day moving average. That's very important. I think that we should press up and see the 209s. That's like if I had to say what is kind of likely to happen, I think that would happen. I really do believe that the Fed was a bit of a game changer. Maybe we get a little bit of correction in the yen issue, but I'm a little less certain because I don't like that we've tested this 204 so many times. This should have been it. We backed off, held it. We should have really pressed up. We didn't. We consolidated and then went down and then up and then down. This is getting very nauseating. So far, I will say this, though, the best thing that the bulls have going for it. I know Friday was a bit of a disappointment. It was a gap up, and it kind of sold off and didn't close super-duper well. However, the key thing to look at there is not this day in isolation. And believe me, you spent 2 days here with, red body candles. The key to look at here is a possible secure low. We have a little bit of like a wick here. You have a higher low here and a higher low here. So technically, this is a low bookended by 2 higher lows. If you can press over the 2-day high here, you will see a move up quite high, I believe. If you were to lose these days' lows and really solidly lose the 204.12 and not just a look below for the algos to run the stops, but I mean a look below and fail and really go, a look below and go. Like if we gap down Monday below this low, this 203.87 or whatever, and then, kind of go, it's not going to be good because now you have all these days of consolidation up at the highs. I do believe that a lot of this consolidation is just these people, all of this distribution, all the people who bought here, all the people bought here are being made whole, and they're just booking some profits. The back off has been really mild. If anything, buyers have materialized. So it would be not good if we lose those lows. I think it would be trouble. And if we take the 2-day highs, really over the 205.23 to 205.25, that's this day's high, these consolidation here, and then this day's high, anything above 205.25 to me is still bullish. So that's the way I would play it. I would say if you're over 205.25 sustainably and you can clear this 205.86, 85, you'll probably see the downtrend line up here close to 209s. And if you, like I said again, if you lose these lows, it's not good. It could get really iffy really quick. Given particularly what I talked about with the VIX, the beer before liquor there. Watch the VIX. IWM is basically clinging here to the 20 MA. You have a similar situation here with the the low bookended by two higher lows. Let's see if the 3-day high can clear. Maybe we'll finally get this gap fill to the 112.16. It sort of seems like that's going to happen. Look here, you have that's really where the volume distribution picks up. There's really no reason not to. So we'll see what happens. If that doesn't happen, it would tell me the IWM is far worse than people think, and maybe there's some real blood coming in the IWM. Qs are really just kind of hanging out, chopping around in this sort of upper distribution. If you start losing the range low here, the old 61.8, that to me would get a little bit iffy. You can see that this has been the strongest one. It's well, I wouldn't say it's well above the 20, but the other ones were basically touching it. This one is kind of holding there. It's kind of working on filling that gap. It's just hovering around there. So Qs, we'll see, looking a little bit better. I think what's going to be the major determinant here are the big boy stocks. I talked about being really more bullish on Apple down in this area. I talked about getting a downtrend touch. We had a bit of a look above and fail. We're coming down. So here's the dealio with that. It's a matter of how severe the back off is, whether we kind of consolidate here and then punch through, or if this is it, and we kind of come back down into the middle of the range. 109.14 to 107.31, that's these lows. It's also sort of really the breakout here. And you have a 20 MA coming in here. If that can hold, then I'll say that Apple is bullish. If we start losing that and really start getting too much into this candle after the gap fill, it gets a little iffy to me. Maybe 100 MA gets tested. That's the lower end of this range here, like the 203, 204 area. You can see 103.74 is a key level for me. And the edge of this distribution is around the 104s. So let's say 104s could get tested if we lose the 107s. So let's keep it simple, stupid. If the 107s hold, then we're good. If they fail, it's not so good. And probably go a little bit lower. All right. So let's not BS each other. What everyone was talking about has been Facebook. This really just is so aggravating. All right, so let me clear up one. Let's do some old business before the new business. All right, so I was asked by someone, a follower on the stream. I don't know if he wants me to mention the name or not. I'll keep him anonymous for now, but his message was what was important. He was basically asking me how I drew in the progression line. I always talk about the infamous Facebook progression line, that moves above it have been unsustainable many times, and this time would be no different. I just want to show you quickly that on this chart, I've talked about 116s being the progression line. This shows it. For some reason, I don't know why. For some reason, I don't know why. This one here shows it up in the 118s. I believe the 116s one is here to be correct. I have no idea why it shows it this way, but it just is what it is. So it got basically the progression line. We got our test, and we got the back off. So I kind of reverse track a little bit on the progression line. I had said it was more of an upper bound because someone was asking me how you draw it in. How do you draw it in? And I said it's a proprietary thing that I draw in, and I thought I really was connecting the tops. However, we are back to the original name. It is not a top connector. It is a regression line. Take a look here. You connect these lows, and I just drew it straight up. You can see it really is a true regression line. It's a proprietary regression line, but it is a regression line. And because we're not going down, it's going up, I dubbed it the progression line. So sorry if I wasn't clear with that. I kind of backtracked it a little bit because I was sort of, for some reason, I thought it was connecting tops, but it's not. It is the progression line. We'll continue calling it the progression line. Anytime, as you can see, we've spent time on it recently. It was support for a while, then it became resistance, and any moves above it have been, I guess, resistant. Simple. I'm going to use it that way until it doesn't work that way. So I mentioned in a couple of week ago video to book some profits up near here, near the 116s. This time was correct again. I was right. I told you, everyone, that this was the time to take off the big bet in Facebook. I was told I was stupid by people who didn't like it, much lower, and then now they loved it up here. Anyway, I warned that there would be some double top talk. No surprise, I started seeing that come in. And this day here, I think, is a trend snapper. Let's see if we draw from here. Yeah, you got a trend break. The good news, there's some good news. The good news is that we are basically holding this breakout. We closed a smidgen below there at 110.63, and we know the 110.15 was really the breakout of this box. And we know the 50 MA is important in Facebook. So I would say that we're on a little shaky ground here, given that we are now making some lower highs. Let me draw the line. We have a mini downtrend going here. I wouldn't get too worked up about it, although we could see a little more correction. We are seeing some lower highs and some lower lows and into some key levels here. If this fails, if we cannot hold the 65, I think we see midway into that range, basically the 50% fib around the 106s, 107s. If that doesn't hold, we have some reference lows here around the 104s. That's kind of the edge of the distribution. It's also the 61.8 in that range. If we have something worse happen with the market getting a little bit steeper, we can use this bigger time frame Fibonacci retracement and think the 99s to 100s will be the more important support. So let's button it up. 50 MA first, between 50 MA and 110.65 is the first key level. Then we're talking 106s, 107s. If we lose that, 104s, and then 199, 100s. That to me is the key area. I would actually love, and I know no one likes this when they're long, but I would love to see a shake and bake. This basically happened on some news. I think it was that the Facebook now, shows news stories in app, and some advertisers were complaining that their traffic was down. I mean, duh. Facebook is showing it. You're not leaving the app. It's in the app. So obviously they're going to lose some traffic. Anyway, that seemed to get, ruffle everyone's feathers. I just think it was really responsive selling from up here, and once people saw that we couldn't kind of take it, they needed to do a little bit of a pullback. So that's what I'm thinking. I'd love to see the shake and bake, have multiple days of selling, multiple days down into support right ahead of the Facebook earnings and set up for a long. That's usually not what happens. Usually it runs into the number, like they do on the Google numbers. So we see it kind of ran. Here you had a little bit of a shake and bake, and look how that resulted in a nice big up move to all-time highs. So I would love to see something like this where we do get a little bit of a sell-off, for a few days, maybe even a couple of weeks into the number, and it sets up for a nice long. That's my view on Facebook. Longer term bullish, short term though I am a little bit cautious here. Amazon I've talked about, as long as it holds over the 585-ish area. The breakout holds. It's just been consolidating. This is looking like it's setting up bullish. If you lose that area, GTFO or row short, at least for a day trade against that level, looks okay to me. The Netflix, we're losing the channel a little bit here, although we did lose it a little here, and it held. 20 MA was really key. I'm just going to say 20 MA. 101 is basically a key level here. This was sort of like the breakout here, the 101, 102. As long as we hold above there, I would say you probably can consolidate and then extend higher. If you start getting below there, it gets a little iffy. You do have some topping tail action here. 103.88 is really important. We do have a bit of a close just below there, 103.81. So if you're aggressive, you could be short against Friday's low for a row trade, or long above the high, anything above 105. If you can clear, by the way, these hammers, these tweezers, I'd be a little cautious here because you do have tweezers against the 200-day moving average. So I would say if you can clear the tweezers and the 200 MA, you will get a squeeze quickly up to the 110, maybe even 113 level. So a little cautious here. if you're aggressive, you can be short below this low, or if you could put it on against these two tweezer tops. But if you do get above there, don't be stubborn. GTFO and maybe even reverse position. That is my view. Google, I've often talked about just kind of trading against the extremes. However, as long as you're above 750.205, I'd rather be long than short. Very, very simple. The Tesla. All right, we ran a lot. I said that 265 plus was the sell. I'm going to stick by that. There's probably going to be a little bit of pullback. If you can clear that area again, I think you're going to fill up to see old all-time highs and probably new all-time highs. However, this was a key, very key technical level. I'll show you on a, 3-year chart maybe. Look at here. Resistance. This resisted here, but we had news here. This wound up being a very prescient area to sell. Resistance, couldn't even get up there. A little resistance, unsustainable above. Look above, fail. Again, look above, fail, resistance. Of course, they're selling. Look what we have a very big range in Tesla, sideways here and here. I don't know if we're going to rotate all the way back down to the lower end of range, although it would not surprise me. Seasonally, this tends to be good for Tesla. It tends to peak out around the end of the summer, sort of toward the horse show. If you look up the Hamptons Classic, someone had posted it. I was going to have it ready for the video, but unfortunately I don't. I will have it for Periscope, I promise. Hampton Classic, look that up. That's when this tends to peak. The only problem I have here is that we're kind of a long way from Kansas here, Toto. A 50% pullback and really key support here. These hammers and a 50% is around 205. Little cautious. If you want to play put ratios, buy something up here and then sell 2 times out of the money here. You'll have a 50% fib, reference lows, hammers, and a 50-day MA and a high volume node. I like that, actually. I think that would be a really sweet area to pull back. I know a lot of people bears have been hanging their hat on the fact that they have to issue equity. Just be careful. Elon Musk loves to do this. He issues equity in smaller amounts than people anticipate. He buys in on the deal, and then it winds up being a buy, not a short. I'd be real cautious with that. Musk basically is maybe the modern day king of short squeezes with the efficiency of a hydraulic press. You don't want to be caught under that. So yeah, I'm a little cautious here. I did talk about taking profits and selling here. Same people who were criticizing me about Facebook, I think were criticizing me on this, telling me I'm crazy. They hated it down here, but they loved it up here, and it's just sort of how it goes. That being said, the 225, this range here is some reference support that basically just, let's say 225 and then 205. I like playing put ratios for a 50% fib. I think that could work well. Chipotle. All right, let's talk Chipotle. I see an interesting setup here. I don't know, maybe Head and Shoulders. You have lows here, reference lows. You had tweezers here. You broke it. You had to look above and fail. If you're below 453.87-ish, 453s, 454s, you don't really want to be long. If you're aggressive, you could play row short. If you do however, have these 2-day high get taken, this to me would be a look below and fail, and the trade would be back up, probably at least to the 50 MA, I would think, the range, at least this range high. So let's use the Friday range, maybe below 448.53 short, above 558.75 long. Very simple. Anyway, that's my story. I'm sticking to it. I hope you guys enjoyed the video. If you did, hit the like button. Also the subscribe button. You'll get notifications for new weekend review videos, also special edition videos, and Periscope rebroadcasts. Leave me some comments. It helps me make my videos better. And follow me on Twitter, @JustinPulitzer. Let's have a good week, and cheers.